This week, on July 10th, SK Hynix lists on the Nasdaq, ticker SKHY, $29 billion, one of the biggest U.S. listings in history, and every headline is screaming the same thing. Buy it. Buy it now, before it's too late. I'm going to tell you the opposite. The single riskiest moment to buy SK Hynix is the exact moment everyone else is buying it. Day 1. Here's the proof. The company just quietly cut its own fundraising target from $29.65 billion down to $28.21 billion. Days before listing, they lowered the price on their own IPO. When a company shrinks its own offering right before it goes public, now that's not noise, that's a signal. And by the end of this video, you're going to know exactly what that signal means and where the real money is actually moving. So why does this video matter to you? Because if you only read the headline, record-breaking IPO, AI chip leader, can't miss deal, you're going to buy exactly when the smart money is being careful, and you'll never even know it. My name is Moon. I obsess over where big money actually moves, especially around massive listings like this one. If you've ever bought something the day everyone was hyping it and then watched it go nowhere for months, this video is for you. Hit subscribe, and if this helps you, drop a like. Today, we're answering 3 questions. Where is the money coming from, and where is it going? Who is actually moving this market? And based on that, where should your attention really be? Let's get into it. Here's what most people assume. Nasdaq listing means instant rocket ship. Alibaba did it. Saudi Aramco did it. So SK Hynix will too, right? Actually, this isn't even a new company going public. SK Hynix has traded on the Korea exchange for over 20 years. What's happening this week isn't a debut. It's a repackaging. Existing Korean shares wrapped into dollar-denominated depository receipts, so U.S. investors can finally buy in. Well, here's a number that should stop you. SK Hynix trades at just 6.2 times forward earnings. Its American rival Micron trades at 7 times, and SK Hynix isn't the little guy here. It controls 56.4% of the entire high-bandwidth memory market, the exact chips Nvidia needs for AI. The market leader is trading cheaper than the number 2 player. So here's the first myth busted. A listing doesn't create value out of nothing. It's a tool to correct a mispricing. And tools, when used at the wrong moment, can backfire. Now here's where it gets really interesting. On June 24th, SK Hynix filed to raise up to $29.65 billion. By July 6th, 4 days before listing, they cut that target to $28.21 billion. Why? Because SK Hynix stock itself dropped in sole trading. On July 6th alone, shares fell 3.4%. This is a stock that's up over 260% this year. And right before its big American debut, it's cooling off. Think about the psychology here for a second. Imagine you're selling something, and right before the sale, you lower the price yourself because demand looks softer than expected. Does that make you want to rush in and buy, or does it make you pause? What people really don't know is that institutional investors read this exact signal during book building. When a deal gets resized down right before pricing, it often means the enthusiasm wasn't quite as hot as the headlines suggested. Now, to be fair, Micron, the American competitor, also corrected nearly 30% over the past month. The entire memory chip sector is cooling, but that makes the timing even more important, not less. Here's what the headlines aren't telling you. 3 major institutions, Baillie Gifford, Coatue Management, and Situational Awareness Partners, have already committed to buying up to $7 billion of this offering before it even opens to the public. Let's do the math. $7 billion is about 25% of the entire $28 billion offering. A quarter of this deal is already locked up by 3 AI-focused funds. These aren't generic investors. They're funds known for betting heavily on AI infrastructure, and that tells you what they actually bought. Not a Korean chip company, but a choke point in the global AI supply chain. Nvidia's CEO himself has called SK Hynix its largest memory partner. So here's the real flow of money. It starts as trapped value on the Korean exchange. It gets unlocked by U.S. institutional capital chasing AI exposure, and it flows straight into new fabrication plants in Yongin, a packaging facility in Cheongju, and advanced chip-making equipment. Every dollar raised goes into future production, not dividends, not buybacks. So why call this a warning at all if demand is this strong? 3 reasons. First, dilution. New shares are about 2.5% of the company. Sounds small, but on a trillion-dollar company, that's over $28 billion of new supply hitting the market at once. Second, arbitrage risk. Look at Taiwan Semiconductors ADR. It trades at a 13 to 21% premium over its local shares. If SK Hynix's US shares and Korean shares aren't freely convertible, the same premium gap could form and stay stuck, meaning US buyers permanently overpay. The third, and this is the big one, memory chips are a boom and bust industry. Just 3 years ago, both SK Hynix and Micron posted losses when memory prices crashed. The new factories being funded right now won't even start production until 2027. By the time that capacity comes online, this AI memory shortage might look completely different. You might be thinking, but Nvidia backs this company, demand can't just disappear. You're right, short term, but the real question isn't whether demand is strong, it's whether that strength is already priced in today. So here's my actual conclusion, and why I opened with it. Day one, pricing isn't information, it's emotion. It's a snapshot made by cornerstone investors and retail hype colliding for a few hours, not a real measure of value. Watch 3 specific dates instead of buying blind this week. First, the 2 weeks after listing. Watch whether the ADR trades at a premium to the Korean shares and whether that gap holds or shrinks. Second, July 29th, when the new Korean shares officially list back home. Watch for supply pressure around that date. Third, and this is the biggest one, December. That's when Nasdaq 100 rebalances and SK Hynix could be added. The Invesco QQQ fund alone manages $482 billion. Even a small index weighting could trigger over $1 billion in mechanical passive buying. That's a real catalyst, not hype. This is my personal read, not a guarantee. Markets can always surprise you. But watching these checkpoints beats chasing a headline. SK Hynix is a genuinely dominant company. That part isn't in question. But a great company and a great entry point are two completely different things. Money always leaves a trail. Today you saw that trail, the shrinking offering, the institutions locking in early, and where every dollar is actually headed. If this helped you see it differently, subscribe and hit like. I'll be back the moment real premium data comes in after listing day. Protect and grow what you've built. See you in the next one.